Hello, this is Ron Henderson, Multi-Real Estate Services in Los Angeles. It's February 29th, 2012, and we're going to go over real briefly what an FHA loan is and how the FHA mortgage insurance structure is going to be changing very soon. The Federal Housing Administration is not a lender and they don't originate loans. FHA guarantees a loan for a lender and acts as a mortgage insurance company. Some lenders market FHA loans as first-time buyer programs, but in reality, anybody that meets the basic guidelines can use it if they've owned properties in the past or even if they own other properties now. Let's be real here. There's a lot of lender and Wall Street bashing about subprime loans being bantered around, some of it very viable. But in reality, an FHA loan is subprime. It allows for a very low 3.5% down and more liberal income, credit, asset, co-borrower, and third-party credit towards closing costs, and generally looser underwriting criteria than a standard conforming loan. Now, there are two issues they're dealing with. One problem is the FHA Mutual Mortgage Insurance Fund that's been taking a hit because of the quantity of foreclosures over the past few years. Thus, the capital reserve levels have dropped below the required amounts. The second problem is the government has to find ways to pay for the Temporary Payroll Tax Cut Continuation Act of 2011. The government's going to attempt to deal with some of this by going to a higher insurance premium structure on any loan where the FHA case number is assigned after April 1st of 2012. There are actually two insurance premiums, the upfront premium and the annual mortgage insurance premium. To cover the insurance fund reserve shortage, the upfront MIP is going to go from 1% to 1.75% of the base loan amount. The increase will apply regardless of the loan-to-value or to the amortization term. That's going to be a big chunk of change, but they do allow for it to be financed into the loan. To help cover the 2-month Social Security tax break, the annual MIP is going to go from 1.15% to 1.25% on loan amounts below $625,500 and 1.5% on higher loan amounts. Here are some ballpark numbers on a $400,000 loan. On the upfront MIP, the premium goes from $4,000 to $7,000, and the monthly increment goes from $383 to $417. This will be an issue for some people trying to buy a property, but it can have detrimental effect on some of those that are trying to make sense out of a refinance. It was only recently that a government plan was released to go ahead and use FHA loans to refinance underwater loans that won't qualify for conventional financing. I mean, the interest rates are still fantastic, but the increase in the mortgage insurance premium sure hurts the numbers. Who knows? The FHA premium, as all the mortgage fees recently, have been moving targets and adjusted often. We'll just have to see where we're at in a few more months. Hope you don't mind if I get on my soapbox for a second. But as I indicated a couple months ago when they imposed new fees on Freddie and Fannie loans, I totally understand how they need to shore up the FHA reserve requirements. Not a problem. But if stabilization of the housing market is such a concern and they've got the Federal Reserve printing up money and buying mortgage-backed securities on the secondary market to go ahead and keep interest rates down, then how can they justify sticking new fees on top of mortgages to go ahead and to finance a tax break that's going to go ahead and supply zero economic results and is totally political in nature? I think I just answered my own question. Anyway, if you're in the Los Angeles region, have any specific questions, always feel free in contacting me through my website, mres.com, or the email or phone number shown below. Till next time, take care.